This is video M4A, and it's the second part of our video review of cost accounting. In this video, we focus on job costing. Okay, let's continue our discussion of cost accounting, and we're going to do a little bit of job costing in this video. So costing is the accumulation, classification, and assigning of cost to cost objects, and we discussed this at length in the previous video. And we typically think of those objects as being either products or services. And so we have three choices that we need to make when we think about costing. The first is how are we going to do cost accumulation. The second is cost measure, and the last is overhead application. So cost accumulation typically follows one of two different types. There's job costing, which means we accumulate cost to a job, and again, a job is associated with a product or service. So for example, if we're building a house, we think about the cost of materials, labor, and the other costs are traced directly to the house. And we can contrast that with process costing, which is to accumulate the cost to a department and then to a product or service. And you typically use process costing when you do homogeneous and often inseparable products, for example, oil refining. So costs would be traced to a department, then applied to finished goods in the bulk. Okay, so just to be clear, let's watch a little video around job costing versus process costing.
So let's first talk about job costing. As we've talked before, job costing will have we can have three, for example here, three different work in process accounts for job 100, job 101, job 102. And each one of those jobs will take a certain amount of product cost. Direct materials, direct labor, and overhead, remember, make up our product cost. Once we've completed those jobs, they moved into finished goods. Then we would simply sell the job. It becomes cost of goods sold. Now if we look at this into T accounts, we see materials, again, move into work in process. Labor, whether it be direct and indirect, are credited to wages payable and applied to work in process. Remember, our materials and our labor are both direct cost, so they're directly traceable to a job. And overhead is applied to work in process via some allocation rate that we have created based on estimates and a cost driver. Then once the job is completed, it moves from work in process with a credit into finished goods with a debit. Then of course we sell the good, we credit finished goods, debit cost of goods sold. So in job costing, we can have an individual work in process account for every job, whereas in process costing, we'll have a work in process account for processes that a product may have to go through. So remember, process costing is when we continually produce the exact same product over and over and over again. For example, number 2 pencils. In this scenario, let's say we are creating Jelly Belly jelly beans. So the first process a jelly bean has to go through is the center. We have to create the center of the product first. So in the centers process, we're going to need a certain amount of direct materials, a certain amount of direct labor, and a certain amount of manufacturing overhead. Then once the center of the Jelly Belly is complete, the center is then transferred to the shells process. And in the shells process, we need additional materials, labor, and overhead, because it's likely that we have different labor, different people, completing the shells process than we're completing the centers process. So we have different labor, we probably have different types of materials, and it may be in a different building altogether, so we may need different lights and machines and that type of thing. Then once the shells have been added to the Jelly Belly, they must be packaged. So the completed shelled Jelly Belly is moved to packaging, where we would likely need more materials, more labor, and overhead. Then once it goes through the final process, it is transferred into finished goods, where it then awaits to be sold, and once it's sold, it's costed as cost of goods sold. If we look at this process in T accounts, we find again, our materials move into each process as they're needed, labor moves into each process as it is needed, and overhead is applied to each process as it is needed. Once the product gets through the final process, it moves into finished goods, and then waits to be sold, and then it moves into cost of goods sold.
Okay, so welcome back. So as examples, we think of doing job costing when we think about construction, printing, manufacturing, shipbuilding, medical services, ad agencies, accounting firms. All these tend to use job costing. And then we think about process costing when we think about the chemical industry, bottling companies like Coca-Cola, plastics, food production, paper products, cement manufacturing, brick production, etc. So a list of things that just are all the same and kind of inseparable from one another. So cost measurement is our next step. And one form of cost measurement is to use actual costs. So you'd use the actual cost of direct materials, direct labor, and overhead costs. And that seems pretty intuitive, right? Just to use actual costs. But you can also use normal cost, or sometimes what they call normal overhead costing, which is to use actual direct materials and direct labor, but use a pre-established rate for overhead. And one of the reasons you do that is because then you do not have to wait for the accumulation of your overhead costs in actual to apply overhead. You can do it as jobs are taking place, and so it's more timely. And then lastly, the one version that is the quickest is standard costing. And in standard costing, you just use estimates for direct costs like labor and materials and overhead. So everything is done using estimates and then is trued up to actuals after the fact. So overhead application is often done using volume-based measures. So each widget is charged with X dollars in direct materials, Y dollars in direct labor, and Z dollars in overhead. And overhead application using a volume-based measure is best in stable production and cost environments. So, when it takes always about the same resources and time to make each product and costs do not vary a great deal, then doing it based on volume makes a lot of sense. So again, back to job costing. So job costing is a product costing system that accumulates costs and assigns them to jobs, customers, projects, clients, contracts. And as you probably should remember from when you took cost accounting before, the basic supporting document in a job costing system is a job cost sheet. And even though the book deals in paper versions, of course, the vast majority of this would be kept in technology today. So there's not really a sheet of paper, but rather an entry into the technology system. So that sheet is going to record and summarize the cost of direct materials, labor, and overhead for a particular job. And each time you start a new job, or sometimes maybe a batch depending, a job cost sheet is started. Okay, let's watch another video, and this one is about job costing.
In this video, we're going to talk about job order costing. So when a firm has multiple different products, let's say a firm that manufactures playground equipment, the firm has to use job order costing when determining its costs. Now, let's just compare and contrast this for a moment with a firm that just has a homogeneous product such as oil. Right? So all oil is basically the same, right? Oil is oil. And so if a firm just is dealing with oil, then they use a process costing system. They don't have to worry about a specific cost for each job, or each time someone orders a batch of oil or a certain amount of oil, they don't have to go and cost it out. It's all basically handled the same way. But when a firm has, for example, different products, such as playground equipment, like a slide, and then they've got swings, and they've got different things. So the firm can't treat these all as just the exact same product, right? They have different costs. It might be that the slide uses entirely different raw materials, takes different amount of labor and everything to build it than a set of swings, right? But oil can just all be just kind of treated the same. So oil, we'd be talking about a process costing system, which we would deal with in another video. But something like playground equipment or any kind of firm that's dealing with different products, right? So different products, we got job order costing, and the idea is just being what kind of product. Is it homogeneous or is it different? So different, we're going to use job order costing, and we're going to come out with a little thing called a job cost sheet, right? So if someone says, hey, I want a slide, I want to order a slide, we're gonna generate a job cost sheet. So let me just give you an idea of what this would look like. We'll just say job cost sheet, and in that job cost sheet we're going to have several things, but things we will definitely have, we're going to have a section for the direct materials or raw materials. I'll just abbreviate that. Direct labor, I'll just abbreviate that, and then manufacturing overhead that is being applied. Okay. Now again, we're going to talk about applied manufacturing overhead because we won't know what the actual overhead is till the end of the period typically. So in our job cost sheet, we've got these three things, and that's going to come out with a cost for the job, right? If someone says, hey, I want this slide, be a nice thing if we could sit down and figure, okay, what would it actually cost for us to make this slide? So let's actually put some numbers to this, and let's call this job A237. So we'll call this is a job cost sheet for A237, job A237, right? There would be a job A238, might be a set of swings, but here's A237, and we're going to cost this out. So let's say that we take a look, and the raw materials for this job, they're $1,000. All right. Now the direct labor, we say, okay, well, it took to build this slide, let's say it took 50 hours of labor at $10 an hour. So if you just multiply the 50 times 10, you're going to get 500. So then the direct labor is 500. Right? Now the manufacturing overhead, now again, this is going to be applied. Now in this case, it depends on the cost driver, but let's say our cost driver is labor hours, so it's applied based on labor hours. And let's say that our predetermined overhead rate, which we have already calculated, which we talk about in another video how to do that, let's say that's $4. Right? So let me just separate that out. So remember, our driver is labor hours, our rate is $4. So we've got 50 labor hours, so we just take the 50 times our rate of 4, and that's going to give us our manufacturing overhead, the amount that we apply to this job, and that's 200. Now, and I should have left a little space, we'll have the total cost for this job. Total cost is going to be $1,700.
All right, so we're going to do an example, and my suggestion is if you need to, pause the video, go get your calculator, go get a scratch sheet of paper, and follow along with us to the extent you can. All right, so we have Quill Corp. Manufactures custom-made whiskey bottles and uses a predetermined overhead rate based on direct labor hours. So they're going to apply overhead using direct labor hours. And estimated direct labor hours are 95,000. Estimated overhead is 617,500. And during the month, they finish job A, but they're unable to finish job B. And you can see on the right, we have all sorts of data. So why don't we pause the video right now and you review this data to make sure you understand what we're looking at. Okay, so let's see if we can figure out what is job A's total cost. So we know that we're going to apply direct materials and direct labor based on actual, but we're going to apply overhead based on a predetermined overhead rate. So we need to resolve what is the predetermined overhead rate. So the first thing we would do is take our estimated overhead and divide it by our cost driver, which in this case was direct labor hours. So the 617.5 divided by the 95,000 is $6.50 per direct labor hour. Okay, we can use this now to aggregate the total costs for job A. So job A's material costs is 65,000. The direct labor costs are 4,200, not dollars, but direct labor hours, times 850 per hour. Overhead is the same 4,200 direct labor hours times our predetermined overhead rate of 650. So now we've got this month's materials, labor, and overhead. To that we can add last month's or any previous month's work in process that had accumulated of 31.2. And we get a total job cost on A of $159,200. And by doing so, now we have an idea as to whether or not we would make money or not on job A, depending on what we sold it for. Okay, so let's think now about the total overhead that we're going to apply. So if we look at the two jobs, job A and job B, total the direct labor hours, multiply that by the $6.50 predetermined overhead rate, we would have applied $50,050 worth of overhead. We can compare that now to our actual overhead. So the way we do that is we go identify what are all the actual overhead cost pools and just aggregate them. So we've got indirect labor of $13,500, supervisor's wages of $6,000, factory rent of $7,000, factory depreciation of $7,500, and indirect materials of $12,000. And notice that we did not include the administrative office costs because those are not part of factory overhead. And so they would not be included in our predetermined overhead. Okay, so we totaled these 46. If we compare that to the actual overhead we applied, we realize that we over-applied overhead to the tune of $4,000. And you probably learned there's a couple of ways of dealing with your over or under applied overhead in terms of allocating it to finished goods, allocating it to work in process, whatever the case might be. That's a little bit beyond the scope of what we need to cover in here, but maybe it does jog your memory a little bit. Okay, so now let's move on to example number 2. And in example number 2, Wayfair Corp manufactures furniture. And cost estimates for a single unit of their product are direct materials, $200. Direct labor at $12 an hour is $300. And the number of machine hours required is 20. And Wayfair's expected production for the period would be 1,000 units. Okay, so over here on the right, we have a table that tracks some of the requirements and some of the costs associated with two departments inside of Wayfair. So think of Department A as maybe construction and Department B as finishing. So in any event, Department A for each product requires 15 hours of direct labor hours and 5 hours of machine hours. Department B requires 10 direct labor hours and 15 machine hours. And the overhead costs associated with each of these departments are variable costs is $150,000 for Department A and fixed costs $94,000. And for Department B, the variable costs are $80,000 and the fixed costs are $163,000. Okay, so if we're going to use a plant-wide rate for allocating factory overhead on a direct labor hour basis, what we do is say, okay, what is our total overhead? And we can just add up the variable overhead and the fixed overhead costs, and we get $487,000. We have a budgeted amount of direct labor hours, right? So that's the 1,000 units we expect to build, plus the 15 direct labor hours in A and the 10 direct labor hours in B. That gives us 25,000 hours total. And using that information, we can simply calculate what is our rate per direct labor hour. $19.48. We could do the same thing except use machine hours as well. So machine hours are 1,000 for 1,000 units. We take the 5 and the 15 from Department A and B. That's 20,000 machine hours. 487,000, which was our total overhead, divided by 20,000 is $24.35 per machine hour. Okay, so in theory, what we have here are two competing ways to allocate overhead based on a predetermined rate. So why don't we track through, and first we'll do direct labor hours. So if we had the 1,000 units produced and we use direct labor hours to allocate our overhead, let's see what would happen. So direct labor for Department A is 1,000 units times the 15 direct labor hours. That's 15,000 of direct labor hours in Department A times the 19.48 predetermined overhead rate we calculated previously. That's 292,200. And for Department B, it's 10,000 hours, direct labor hours times 1948, or 194,800. Okay, we can do the exact same thing using the machine hour basis. So if we use machine hours, 1,000 machine hours, or sorry, 1,000 units times the 5 machine hours in Department A gives us 5,000 times 2435, or 121,750. We can do the same thing for Department B. 1,000 units times 15 machine hours is 15,000 hours total, times 2435 is 365,250. Okay, so why did we go through this process? Well, largely so we could compare the two. Okay, so let's look as if we allocated our overhead using direct labor. Department A has 292,000, Department B 194,000. If, on the other hand, we use machine hours, we can see Department A is 121,000 or so, but Department B is 365. So you can see that using a plant-wide overhead rate to allocate may not make sense. So for example, if you're the manager of Department A, which allocation rate would you prefer? And clearly you'd go with machine hours. Department B is likely to prefer direct labor hours. So we need to be able to provide a better solution. And one of the ways we could do that is, look, when we look at the way these activities are breaking out, what Department A does is more dependent on direct labor hours. And what Department B does is more dependent on machine hours. So rather than use a single rate for everyone, why don't we break up the way we apply the overhead? So we'll apply Department A's overhead based on direct labor hours. Okay, so Department A has 244,000 of estimated overhead costs. They have 15,000 of direct labor hours, which is the 1,000 units times the 15 direct labor hours. That's 1627 per direct labor hour. And then, of course, we just redo that math. 15,000 times 1627 is 244,000. If we do Department B based on machine hours, we take their total overhead divided by 15,000, we get 1620. So what happens is, by using segregated costs and drivers by department in this case, in theory you're going to get better results because you're more closely tying the overhead allocation to the cost driver associated with that, in this case, department. So now if Department B goes over budget on machine hours or costs, that's going to affect their overhead allocation and their results. But all this comes at the cost of complexity. So you almost always get more accurate results if you use multiple drivers than single drivers. So the question is, how many drivers can you have? Well, in Chapter 5, we're going to spend some time talking about exactly how that's done. And so the good news is, that is the end of video M4A and the end of our review. We start Chapter 5 and activity-based costing next. Thanks for watching.